Do not let the quiet fool you. Right now, the markets feel calm. Screens look lifeless. Charts appear frozen. Prices seem stable, almost boring. Gold isn't screaming. Silver isn't exploding. To the untrained eye, nothing is happening. But this moment, this exact moment, is when the biggest moves in financial history are born. Silence in markets is not peace. Silence is pressure. We are standing at the edge of 2026. And beneath the surface of this calm, the global financial system is grinding against its own limits. Capital is trapped. Liquidity is mispriced. Inventories are thin. And the institutions, the ones that actually move markets, are preparing for something most investors are not emotionally ready for. Gold and silver are no longer just commodities in this story. They are pressure valves for a system that can no longer breathe. What makes this moment different from every other prediction cycle you've heard is not optimism. It's mechanics, it's timing, and it's positioning. We are entering a phase where markets stop reacting to headlines and start reacting to structural necessity. In 2026, gold and silver will not move because people feel bullish. They will move because the system has no alternative. Let IS start with the most misunderstood truth in finance. Markets do not move when everyone agrees. They move when positioning flips. They move when the largest players are forced to act at the same time. And right now, those players are trapped by calendars, mandates, and models that do not care about opinions, only allocation. Every major pension fund, sovereign wealth fund, insurance pool, and institutional allocator begins the year with the same problem: rebalancing. December is about defense. January is about offense. December is when risk is reduced, profits are locked in, and balance sheets are cleaned for regulatory snapshots. January is when capital must be deployed, whether prices are convenient or not. This is not speculation. This is how institutional finance works. Trillions of dollars are governed by rigid rules, and those rules say that in 2026, exposure to hard assets is no longer optional. Inflation didn't disappear, it went quiet. Debt didn't shrink, it metastasized. And confidence in fiat stability is eroding faster than policymakers are willing to admit. Gold and silver sit at the center of this reallocation storm, not because they are trendy, but because they are unescapable. When confidence fades, capital doesn't ask permission. It migrates, and it always migrates toward assets with no counterparty risk. Here's the problem: there isn't enough metal. For years, the paper markets created the illusion of abundance. Futures contracts multiplied supply on screens while physical inventories quietly drained. Vault reports were massaged. Delivery mechanisms were stretched. Leverage replaced ownership. But leverage only works until someone asks for the underlying asset. And in 2026, that question is being asked by industry, by governments, and by institutions simultaneously. Silver is the canary in the system. It is both an industrial input and a monetary metal. It is consumed, not just stored. Every solar panel, every EV, every data center expansion quietly eats into above-ground supply. Unlike gold, silver does not sit idle. It disappears, and that disappearance is accelerating. The market price, however, has not kept up. Not yet. This is how all structural squeezes begin. Price lags reality until the moment it doesn't. And when that snap happens, it is violent. It does not wait for consensus. It does not offer second chances. Gold, meanwhile, is undergoing its own transformation. For decades, it was dismissed as a relic, an inert hedge with no yield. But yield no longer matters when real returns are negative, when debt servicing costs exceed growth, when confidence erodes faster than central banks can respond. In that environment, gold stops being an investment and starts being a reserve again. Central banks understand this. That's why they've been accumulating gold quietly, consistently, and aggressively, not trading it, not flipping it, storing it, removing it from circulation, preparing for a world where trust is fragmented and settlement requires something more than promises. Silver follows gold, but not linearly. Silver lags, compresses, then overshoots. Historically, silver underperforms until the monetary phase begins. Then it accelerates violently. This isn't theory, it's pattern. And patterns repeat when the underlying conditions match. Those conditions are now in place. Debt levels are no longer theoretical. They are mathematically unserviceable. Interest expenses crowding out government budgets. Bond markets are revolting, not with headlines, but with yields. Every basis point higher tightens the noose around fiscal stability, and central banks are trapped between inflation and insolvency. This is where gold and silver thrive, not because they are perfect, but because everything else is flawed. The illusion of control is fading. Rate hikes didn't kill inflation. They exposed fragility. Liquidity withdrawals didn't normalize markets. They revealed dependence. And now policymakers are discovering the truth markets already know. There is no painless way out. In 2026, the playbook changes. Instead of fighting inflation, central banks will manage perception. Instead of restoring purchasing power, they will prioritize system stability. And that means liquidity, explicit or disguised, will return. It always does. History is brutally consistent on this point. When liquidity returns, it doesn't flow evenly. It seeks scarcity. It seeks safety. It seeks assets that cannot be printed to infinity. That is the role gold and silver are about to reclaim. But here's the critical difference this time. Positioning is wrong. Most retail investors are exhausted. They were shaken out by volatility. They were conditioned to distrust metals by years of sideways action and sharp pullbacks. Meanwhile, institutions reduced exposure under regulatory pressure and year-end constraints. The result is a market that looks calm, but is structurally underowned. That is the most dangerous configuration in finance. When ownership is light and necessity is heavy, price becomes a weapon. The first move is disbelief, the second is denial, the third is panic. We are approaching the end of disbelief. The signals are subtle but unmistakable. Physical premiums are diverging from paper prices. Delivery times are stretching. Industrial users are locking in supply outside exchanges. Eastern markets are paying higher prices than Western screens reflect. Arbitrage is draining inventories quietly, relentlessly. These are not bullish indicators. They are stress fractures. Gold and silver do not announce regime changes with fireworks. They whisper. Then they gap. What makes 2026 different is synchronization. In past cycles, demand arrived in waves, retail first, institutions later, or inflation first, crisis later. This time, everything is converging at once. Debt stress, geopolitical fragmentation, industrial demand, currency distrust, and institutional reallocation. That convergence compresses time. Moves that used to take years can now happen in months or weeks. This is why the next move in gold and silver will not be normal. It will not respect technical comfort zones. It will not wait for confirmation. It will punish hesitation and reward preparation. And once it begins, the narrative will flip overnight, from boring metals to, why didn't anyone see this coming? They always ask that question after the move, but the truth is visible now to anyone willing to look past price and into structure. The calm you see today is not stability, it is coiled energy. And markets do not dissipate energy gently, they release it violently. As 2026 opens, the system will begin repricing risk, trust, and scarcity all at once. Gold and silver are not the trade of the year. They are the consequence of the last decade. And consequences do not negotiate. This is only the beginning. The biggest mistake investors make is believing markets move because of opinions. They don't. Markets move because of pressure. Pressure from balance sheets, pressure from shortages, pressure from mandates that must be executed regardless of price. And right now, the pressure inside the gold and silver markets is reaching a level where human emotion no longer matters. The illusion that precious metals are controlled only exists when supply is plentiful and demand is optional. That illusion collapses the moment demand becomes mandatory. In 2026, demand for gold and silver is no longer a choice for institutions. It is a requirement imposed by risk models, political instability, industrial necessity, and currency erosion. This is where the story turns dangerous for anyone who is not positioned. Let's talk about institutional behavior, because this is where retail narratives completely fail. Large institutions do not chase price. They chase allocation targets. When those targets shift, they do not ask whether the market is ready. They force the market to comply. This is why the most violent price moves always happen when institutions flip from passive to urgent. That flip is already underway. In 2025, institutions were defensive. They reduced exposure to anything volatile. They trimmed commodities. They leaned into cash and short-duration instruments, believing higher rates would protect purchasing power. That assumption is now breaking down. Inflation is no longer falling fast enough. Debt service costs are exploding. Real yields are negative when measured honestly, and portfolio models are adjusting accordingly. The models don't care about sentiment. They don't care about headlines. They care about correlation, drawdown risk, and long-term purchasing power. And right now, those models are flashing the same signal they flashed before every major commodities supercycle in history. Underexposure. Gold and silver allocations across pensions, endowments, and sovereign funds are historically low relative to systemic risk. That imbalance cannot persist. When it corrects, it does not correct gently. Here's the critical problem. The physical market cannot absorb institutional-sized demand at current prices. Paper markets can absorb anything. You can create infinite futures contracts with a keystroke. Physical markets cannot. They're constrained by mining output, refining capacity, logistics, and inventory. When institutional demand spills from paper into physical, either directly or indirectly, the entire pricing mechanism breaks. Silver is the weak point. Silver is not just scarce, it is disappearing. Unlike gold, which is hoarded and recycled, silver is consumed. Once it enters an industrial process, much of it is gone forever. Recycling is expensive, inefficient, and lagged. The result is a market that looks liquid on screens, but is brittle in reality. This brittleness is already visible if you know where to look. Delivery delays are increasing, premiums are rising even when spot prices fall. Industrial buyers are bypassing exchanges and securing supply privately. Eastern markets are paying higher prices than Western benchmarks. These are not anomalies, they are symptoms of stress. When stress reaches a critical point, pricing authority shifts. Futures markets lose credibility. Spot prices become irrelevant. The real price becomes whatever clears physical supply. This is how commodities reset. Gold follows a different but equally powerful path. Central banks are the key here. They are not speculating. They are repositioning reserves for a fragmented monetary future. Gold is neutral. Gold is portable. Gold has no counterparty risk. In a world where trust is splintering, those qualities matter more than yield. The accumulation has been steady, quiet, and persistent. Central banks do not buy tops. They buy necessity, and they do not sell when prices rise. They remove metal from circulation permanently. That creates a one-way supply drain that paper markets cannot offset. As gold inventories tighten, silver inherits the overflow demand. Investors priced out of gold rotate into silver. Industrial users compete with monetary buyers. This dual demand profile is what creates explosive moves. But the trigger is not demand alone. It is urgency. Urgency appears when markets realize supply cannot respond. Mining cannot ramp quickly. New projects take years. Political risk is increasing in key producing regions. Environmental restrictions are tightening. Capital investment has been underfunded for a decade. Even at higher prices, supply response is muted. This is the structural deficit no one wants to price honestly. Now layer macro pressure on top. Governments are trapped. Debt levels are too high to tolerate restrictive policy for long. Every attempt to tighten breaks something: banks, bonds, housing, or credit markets. Each break forces intervention. Each intervention expands the monetary base. This cycle is not hypothetical. It has repeated globally for 15 years. Markets know this. That's why long-term confidence in fiat stability is eroding even when short-term calm appears. Stability is being purchased with future purchasing power. Gold and silver are the escape valves. When capital realizes that cash is not safety, it moves fast. When institutions realize that diversification requires hard assets, they move bigger. And when both happen simultaneously, price action becomes discontinuous. This is where most investors freeze, because the move doesn't look rational in real time. It looks chaotic. It looks manipulated. It looks too far, too fast. But from a structural perspective, it is overdue. Silver, in particular, has a history of compressing volatility for years, and then releasing it in months. The longer the compression, the more violent the release. That release is not linear. It is punctuated by gaps, halts, and panic repricing. Those who wait for confirmation miss it. Those who demand perfect entry are run over. Gold's move will look calm by comparison. It will be steady, relentless, and confidence-driven. Silver's move will be emotional, chaotic, and shocking. That is always the pattern when monetary and industrial demand collide. Another factor few discuss openly is geopolitical stockpiling. Nations are quietly securing strategic resources. Silver is critical to energy infrastructure, defense systems, electronics, and communications. In a deglobalizing world, access matters more than price. Once governments view silver as strategic rather than commercial, supply tightens permanently. Export controls, domestic stockpiles, and preferential allocation distort markets. Price becomes secondary to availability. This is already happening, just not loudly. Western markets still price silver as if it is abundant. Eastern markets are behaving as if it is scarce. That divergence cannot last. Arbitrage drains inventory from the cheaper market until equilibrium is forced. That equilibrium is always higher. At the same time, speculative leverage has been reduced. That matters. When leverage is high, markets can be smashed easily. When leverage is low and physical ownership is high, downside collapses are limited. Upside, however, becomes explosive because there are fewer forced sellers. This is why dips in late cycles become shallow and brief. Sellers disappear, buyers remain, volatility shifts direction. The final accelerant is psychology, not retail psychology, media psychology. Once mainstream narratives flip from dismissal to fascination, capital floods in, ETFs swell. Derivatives expand. Momentum funds pile on. That phase is not here yet, but it comes fast once price breaks key psychological thresholds. When that happens, the question is no longer, why is this happening? It becomes, how high does this go? By then, positioning is already established. Late buyers chase. Early holders endure volatility but hold advantage. This is the asymmetry of hard asset cycles. Downside is limited by cost and scarcity. Upside is unlimited by necessity and fear. 2026 is not about speculation. It is about repricing reality. Gold and silver are not being repriced because of one event. They are being repriced because a decade of policy choices has reached its mathematical conclusion. Debt cannot be paid honestly. Growth cannot outrun interest forever. Confidence cannot be printed. When trust breaks, metal rises, not as a trade, as a refuge. And once that refuge becomes crowded, the move accelerates beyond what fundamentals alone would justify. That is not irrationality. That is survival behavior expressed through markets. Those who understand this do not argue about daily candles. They prepare for regime change, because when the regime changes, price action stops asking for permission. It simply moves. At this stage of the cycle, analysis stops being the edge. Execution becomes the edge. Most people fail not because they were wrong about direction, but because they were unprepared for intensity. Markets do not move slowly at inflection points. They move violently, emotionally, and without warning. If you wait for comfort, you will not participate. If you wait for clarity, you will buy late. The purpose now is not prediction, it is preparation. The first rule of execution in 2026 is understanding that volatility is no longer a signal of danger. It is a signal of transition. When markets are calm, they are complacent. When markets are chaotic, they are repricing reality. Gold and silver are entering a phase where price swings will test conviction daily. That does not mean the thesis is broken. It means the thesis is being realized. This is where weak hands disappear. The biggest psychological trap investors fall into is anchoring to price. They remember where they should have bought. They fixate on missed entries. They hesitate because the price feels higher than it used to be. This is irrelevant. What matters is not where price was, but where purchasing power is going. Hard assets do not care about your entry regret. They care about scarcity, necessity, and trust. Execution begins with position sizing. You do not need to be all in. You need to be correctly positioned. Overexposure creates panic. Underexposure creates regret. The goal is durability. You want a position size that allows you to sleep while others panic and hold while others trade emotionally. That is how wealth compounds during structural shifts. Leverage is the enemy here. Leverage turns volatility into liquidation. The biggest winners in hard asset cycles are not the most aggressive traders. They are the most patient holders. Physical metal, unlevered exposure, and long duration positioning outperform speculation every time the system destabilizes. This is not the cycle to gamble. This is the cycle to endure. Timing also matters less than participation. Many people obsess over picking the bottom or selling the top. Those points are invisible in real time. What is visible is trend structure. When higher lows form, when supply tightens, when macro pressure builds, the correct action is alignment, not precision. You do not need perfection. You need exposure. Now let's talk about exits, because this is where discipline separates winners from bag holders. The mistake most people make is thinking they will know when the top is in. They won't. Tops feel euphoric. They feel justified. They feel obvious only in hindsight. That's why exits must be rule-based, not emotion-based. The most effective framework is relative value, not absolute price. Selling for currency is rarely optimal during monetary stress. Selling for stronger assets is. This is why ratio analysis matters. Gold to silver ratios compress during bull markets. When that compression reaches historical extremes, risk shifts. That is where rebalancing makes sense. This is not about abandoning silver or gold. It is about graduating from speculation to preservation. Another execution principle is ignoring noise. News cycles will become louder. Commentary will become more extreme. Bullish voices will shout higher targets. Bearish voices will predict collapse. Both are distractions. Markets do not reward attention. They reward alignment. Every cycle produces false signals designed to shake out conviction. Sharp drops, sudden rallies, surprise headlines. These are features, not bugs. They exist to transfer assets from the impatient to the prepared. If you react emotionally, you become liquidity for someone else. The correct response to volatility is not action. It is evaluation. Ask simple questions. Has supply improved? Has demand vanished? Has policy fundamentally changed? If the answer is no, then price movement is noise, not signal. One of the most dangerous moments in any cycle is early success. When positions move in your favor quickly, ego grows. You feel smart. You feel validated. This is when people overextend, chase leverage, and abandon discipline. That behavior destroys gains. Remember this. Bull markets end because of excess, not doubt. They peak when everyone agrees, not when everyone is scared. Fear is fuel. Confidence is danger. As participation increases, expect manipulation attempts, expect margin changes, expect regulatory pressure. These are not signs of failure. They are signs of importance. Markets only intervene when outcomes threaten established systems. Suppression attempts often precede the strongest moves. Do not confuse intervention with control. Authorities can slow markets. They cannot reverse structural imbalances. Another execution layer is time horizon. Short-term traders will be punished in this environment. Algorithms dominate intraday action. Headlines dominate weekly swings. Long-term holders benefit from monthly and quarterly resolution. If you cannot hold through a 20% drawdown without panic, your position is too large. This is not a flaw. It is information. Reduce size until you can think clearly. Now let's talk about expectations. The move ahead will not be smooth. There will be corrections that feel terminal. There will be rallies that feel fake. Both will be wrong. Structural repricing is not linear. It is episodic. Plateaus, spikes, consolidations, and sudden breaks are normal. The biggest gains often come when participation feels lowest. The biggest losses come when participation feels safest. This is why patience matters more than intelligence. We also need to address the idea of missing out. Fear of missing out causes poor decisions. There will always be pullbacks. There will always be opportunities. Chasing parabolic moves without structure is gambling. Structured exposure held through volatility is investing. Your goal is not to capture every dollar. Your goal is to protect and grow purchasing power across cycles. As gold and silver move higher, your environment will change. Conversations will change. Skeptics will become curious. Curiosity will become urgency. Urgency will become mania. This progression is predictable. What is unpredictable is timing. When that mania arrives, your job changes. You stop adding, you start observing, you prepare exits, you ignore applause. Because applause marks the end, not the beginning. One final execution principle. Do not measure success in fiat terms alone. Fiat currencies are the denominator that is failing. Measure success in what your assets can acquire. Energy, land, security, optionality. Hard assets are bridges, not destinations. When the bridge has served its purpose, you cross it. You do not live on it forever. As 2026 unfolds, remember this. Markets do not reward certainty. They reward preparedness. They reward patience. They reward those who understand that wealth is not made by predicting headlines, but by positioning ahead of structural change. Gold and silver are not trades anymore. They are signals. Signals that the old system is straining and a new valuation regime is forming. Those who listen early move quietly. Those who listen late move emotionally. Choose wisely. If this analysis helped clarify the road ahead, hit the like button. It tells the algorithm this content matters. Share this video with anyone who still thinks precious metals are boring. Education spreads faster than price. And subscribe to the channel if you want clear, no-noise breakdowns of gold, silver, and macro shifts as 2026 unfolds. This cycle will not wait. Be prepared, and I'll see you in the next update.